Thank you and welcome to Mastering Accounting. This is the second video in this series, and my advice is that you watch the videos in a sequential order for easy learning. You may consider subscribing to this channel for free access to these videos. In this video, we are going to look at source documents which provide data into the accounting system. So you do understand that details of financial transactions are usually described on various documents, some which are received from external sources and others which are produced within the accounting system of an organization. These documents will provide the data which acts as an input into the accounting system. As such, these documents are usually referred to as source documents. Some of the source documents we are going to pay keen attention to include purchase order, receipts, sales invoice, purchases invoice, credit notes, debit notes, and payment vouchers. Let us start by looking at purchase orders. A purchase order is a document which is prepared by the buyer and is sent to the seller, and it indicates the types, quantities, and agreed prices for products or services the seller will provide to the buyer. So in our business, when we send purchase orders, we are basically sending documents to the suppliers, and we want the suppliers to supply the goods according to the specifications or according to the details you have given in the purchase orders. Sending a purchase order to a supplier constitutes a legal offer to buy a product or a service. Acceptance of a purchase order by the seller usually forms a contract between the buyer and the seller, but there is no contract which exists unless a purchase order is accepted. Why do we use purchase orders? We use purchase orders usually to control purchasing of products and services from external suppliers. So when we want information on purchase of stock within an organization, the documents which would provide such information are the purchase orders which have been sent to suppliers. So copies of such purchase orders will always provide information which will help you in a business to know the amount of stock which has been ordered within a particular period of time. Another very important document which provides information to the accounting system is a receipt. At some point, you must have bought a product, maybe a product of value, a value which exceeds maybe 200 shillings. So when you've bought such a product, you receive your product and a document which acts as proof that you've made payment for such a product. So this document, which acts as proof of payment of cash, is usually what we refer to as a receipt. So a receipt is raised by the business and is issued to a client all the data to the business when these clients or debtors make payments in form of cash or through the bank, and they present maybe a check to the business. So once we have received the payment, we acknowledge the receipt of this payment by giving the person or the institution which has made payment an acknowledgement which is called a receipt. So in accounting, when we want to know all payments which have been received by the business, the documents which will provide such information are receipts, because every payment is usually acknowledged by issuing a receipt to the person who has made the payment to the business. Another important document which provides information to the accounting system is a sales invoice. A sales invoice is a document which is prepared by the business and is sent to clients to inform them the amount which is due in exchange for goods and services which have been delivered to these clients on credit. So when we have sold goods on credit, that document which will act as proof that goods have been sold on credit to clients are called sales invoices. So every client or every client who has bought goods on credit will always receive an invoice, and that invoice is proof that this client has bought goods on credit and is expected to pay the amount which is indicated in the invoice. So the invoice will contain details relating to the transaction, such as the product details, which kind of product did this client buy. It contains details about the quantities the client bought. Once you've indicated the type of the product, you also need to indicate the quantity that the client bought. Any discount given is also indicated on that invoice, and the total amount the client is expected to pay. The invoice may also contain a brief summary of the terms of transaction, and this may include lag time. For example, when do you expect the client to pay? Lag time is the maximum number of days which the client is allowed credit. In other words, there are businesses which will allow clients to pay after 1 month. There are those which will allow the clients to pay after 2 months. Others will allow clients to pay after 3 months. So lag time depends on the policy of the business. So this lag time is also indicated at the invoice so that the client will make arrangements to make payments when they will fall due. So when we need information, when we as accountants, we want to record all credit sales, we will get that information from the invoices which we have sent to clients who have bought goods on credit. Another document which provides information to the accounting system is a purchases invoice. So purchases invoice are documents which we receive as proof that we have bought goods on credit. So purchases invoice are not prepared by the business, but rather they are prepared by the suppliers. When we have received goods or services on credit, the supplier of the goods or the services will always prepare a purchase invoice, and they will send that purchase invoice to us as proof that we bought goods or services from him on credit. So when in the accounting system we want to get all the details of suppliers who have sold goods to us on credit, we will always check on the invoices which have been received. Another important document which provides information to the accounting system is a credit note. So in a business, sometimes after selling goods on credit to clients, clients may realize that some of the goods are either faulty or they are not meeting their specifications. So what the clients do, they return those goods to the business. So when clients have returned goods back to the business, we don't expect these clients to make payments for the goods they have returned to the business. So what happens is that the amount of money we were expecting from these clients goes down. The amount of money we were expecting the clients to pay reduces. So we have to prepare a document which informs them that now the amount of money we expect has reduced from this much to this much. So this document is called a credit note. So a credit note is a document which is prepared by the business and is issued by, and the document is issued to the debtor when the debtor has returned some goods back to the business. So the purpose of the credit note is to inform the debtor or the customer that the debtor's account with the firm has been credited. That is, when the account of the debtor is credited, usually it means that the amount we expect from this creditor, from this debtor, has reduced, has gone down. So we are informing our debtors that the amount that they are expected to pay has reduced, and the reason of the reduction is because there are some goods, goods of some amount which have been returned back to the business because they did not meet the specifications of the customer. Another document is a debit note. So a debit note is a document which can be prepared either by the business or it can be prepared by the supplier. So when it is prepared by the business and sent to the supplier, this document means or acts as a means of communicating or requesting the supplier to issue you with a credit note when you have returned some goods back to the supplier. So sometimes we as a business receive goods from suppliers and the goods don't meet our specifications. So what do? We return some of these goods back to the supplier, and we are not expected to make payment for such goods. So once we have returned goods back to the supplier, we may prepare a debit note and send it to the supplier as a way of requesting the supplier to write a credit note to us. And to us now, this credit note the supplier will write will basically indicate that the amount he expects from us has gone down or has reduced. Sometimes a debit note is also written by the supplier and sent to us as a business. So when can this happen? Sometimes we buy goods, and when the supplier is preparing the invoice, there is an undercharge in that invoice. So when the supplier has realized the undercharge, he needs to correct the undercharge either by issuing an additional invoice or by issuing a document called a debit note. So a debit note can be used by the supplier to correct an undercharge instead of the supplier sending an additional invoice to us. So if we had purchased goods on credit from a given supplier, the supplier has realized that the amount in that invoice is lower than it is supposed to be. To correct that, you will have to send a document to us, which will act as proof that now the amount has gone up. When we are going to pay more than the invoice was indicating. So that document which shows that the amount has gone up, in other words, a document which corrects an undercharge, is a debit note. So a debit note is used in two ways. It can originate from the business to the supplier, and that way it acts as a formal request for a credit note when goods have been returned to the supplier. And it can also originate from the supplier to the business, and in that case it is correcting an undercharge instead of the supplier sending additional invoice to the business. So whenever we want information about correction of undercharge, we want information about goods which were sold and they were goods which were bought and they were returned back to the supplier. We will always consult these documents called the debit notes. The last document we are going to look at is a payment voucher. Sometimes in a business, you realize that there are some goods which we give a name, petty goods or petty services. Petty in the sense that not that the services or the goods are not important, but the goods or the services require a small amount of money which cannot which we cannot keep opening, or rather which we cannot keep opening accounts for, or which we cannot keep indicating in the cash book that the payments were made. So in such cases, what we do, we prepare documents which act as an evidence that the little amounts were spent, and they were spent for particular purposes within the business. So when we are spending this petty cash, the document which will act as proof that indeed petty cash was paid is a payment voucher. This payment voucher also helps those people who supply those small goods to the business, all the small services to the business, and they don't have receipts themselves to give to the business when it makes payment as evidence that they have received the money from the business. So vouching is that process of preparing the documents which will the provider of service or goods will sign as a confirmation or as proof that indeed he has been paid for his goods or services. So payment vouchers are used where the business runs an interest system which now makes use of petty cash. There are other source documents which may be of help when we are preparing accounting books, and these may include documents like quotations, remittance advice, statements of account, and bank statements. All these are documents which are very relevant when it comes to preparation of books of account. So thank you, and hope we are going to share more in the subsequent videos. Thank you very much.